Hello, welcome to Chapter 5 as we explore revenue recognition. This determines when and how much revenue appears in the income statement. Part of this chapter we're going to talk about the general approach for recognizing revenue in 3 situations: at a point in time, over a period of time, and for contracts that include multiple parts that might require recognizing revenue at a different time. And then in another section we're going to see how to deal with special issues that affect the revenue recognition process. And then in the third part we're going to talk about how to account for revenues in long-term contracts. According to the FASB's conceptual framework, revenues are inflows or other enhancements of assets of an entity, or settlements of liabilities, or could be a combination of both, from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. In simple terms, we can say that revenues generally would be the inflow of cash or accounts receivable that a business receives in exchange for providing goods and services to its customers. For many companies, revenue is the single largest number reported in the financial statements. Its pivotal role in the picture painted by the financial statements makes measuring and reporting revenues one of the most critical aspects of financial reporting. It's not only important to determine how much revenue to recognize, but also when to recognize it. A one-year income statement should report a company's revenues for only that 1 year period. Revenue recognition previously was based on the realization principle, which recognized that we recognize revenue when both the earnings process is complete and there is reasonable certainty as to the collectability of the assets to be received. Now, this realization principle had some problems. Revenue recognition was poorly tied to the FASB's conceptual framework, which stresses a balance sheet focus that places more emphasis on recognizing assets and liabilities rather than on the earnings process. Also, the focus on the earnings process led to similar transactions being treated differently in different industries. And the realization principle was difficult to apply to complex arrangements that involved multiple goods and services. The FASB and IASB worked together to develop a new revenue recognition standard, which the FASB has issued as Accounting Standards Update ASU 2014-9, Revenue from Contracts with Customers. The IFRS version is IFRS number 15. The ASU provides a unified approach for revenue recognition that replaces more than 200 different pieces of specialized guidance that had developed over time in U.S. GAAP for revenue recognition under various industries and circumstances. Because you need to understand the revenue recognition requirements that will be in effect during your career, we're going to focus on ASU 2014-9. The core revenue recognition principle states that companies must recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods and services. So the when is upon transfer of goods and services to customers, and the how much is the amount the seller is entitled to receive for those goods and services. This slide shows the core revenue recognition principles and the 5 steps that are used to apply the principle. Let's start with the core revenue recognition principle and the key steps we use to apply this principle. All revenue recognition starts with a contract between a seller and a customer. Contracts between a seller and a customer contain one or more performance obligations, which are promises by the seller to transfer goods or services to a customer. The seller recognizes revenues when it satisfies a performance obligation by transferring the promised good or service. We consider transfer to have occurred when the customer has control of the good or service. Control means that the customer has direct influence over the use of the good or service and obtains a benefit. For many contracts, following this approach is straightforward. If a contract includes only one performance obligation, we typically just have to decide when the seller delivers the good or provides the service to a customer, and then make sure that the seller recognizes revenues at that time. Transfer of control could happen either at a single point in time or over a period of time. So revenue is recognized accordingly at a point in time or over a period of time. And if a contract contains multiple performance obligations, the timing of revenue recognition is determined separately for each performance obligation depending on when that performance obligation gets satisfied. So let's take a look at our very first question here. Which of the following is not a step used to apply the core principle of revenue recognition? A. Determine the transaction price. B. Identify the performance obligations in the contract. C. Identify the contract with the customer. Or D. Ensure the sales price is fixed and determinable. As you see here, the key that is not a step in applying this principle is to ensure the sales price is fixed and determinable. In order to have revenue recognition, we've got to determine the transaction price and the performance obligations along with the contract with the customer. Let's first consider recognition of revenue at a single point in time. We consider transfer of goods or services to have occurred when the customer has control of the goods or services. The key indicators for the transfer of control are that the customer has an obligation to pay the seller, there's legal title to the asset, or physical possession of the asset, the customers assume the risks and rewards of ownership and has accepted the asset. Sellers should evaluate these indicators individually and in combination to decide whether control has been transferred, and revenue then can be recognized. In this slide, we apply these indicators to True Tech Industries, a company we'll revisit throughout this chapter. So True Tech has received the order but hasn't fulfilled its performance obligations to deliver try boxes. In light of this and other indicators, True Tech's judgments that the control has not been transferred and revenue should not be recognized. On December 20th, True Tech has received the order, but it hasn't yet fulfilled its performance obligation to deliver the try boxes. As True Tech has not transferred control of goods, revenue shouldn't be recognized. Now on January 1st of 2018, True Tech delivers 1,000 try boxes to comp stores, and title to the try boxes transfers to comp stores. True Tech has delivered the try boxes and comp store has accepted delivery. So comp stores has physical possession, has legal title, the risks and rewards of ownership, and an obligation to pay True Tech. True Tech's performance obligation has been satisfied. So True Tech can recognize revenue and a related accounts receivable of $240,000. Then on January 25th of 2018, True Tech receives $240,000 from comp stores. This transaction does not affect revenue. We recognize revenue when performance obligations are satisfied, not when cash is received. True Tech simply records collection of the account receivable. So let's look at a question here. Which of the following is not a key indicator used in deciding whether control has passed from the seller to the buyer? A. Seller can identify the contract with the buyer. The buyer has an obligation to pay the seller. The buyer has legal title to the asset. And D. Buyer has physical possession of the asset. Now, which of the following is not a key indicator that the seller can identify the contract with a buyer? The buyer is more likely to control a good or service if the buyer has an obligation to pay the seller, the legal title, the physical possession, assumed the risks and rewards, and accepted the asset. Which of the following is not an indicator that control of a good has passed from the seller to the buyer? A, buyer has legal title. B, buyer has an unconditional obligation to pay. C, buyer has scheduled delivery. Or D, buyer has assumed the risk and rewards of ownership. So, which of these is not an indicator would be C. Whether the buyer's scheduled delivery is not an indicator of passage of control. Companies recognize revenue over time if either the customer consumes the benefit of the seller's work as it is performed, when a company provides cleaning services to a customer for a period of time. 2, the customer controls the asset as it is created, such as when the contractor builds an extension onto a customer's existing building. Or, number 3, the seller's creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payment for progress to date, which would be when a company manufactures fighter jets for the Air Force. For example, assume TrueTech sells one-year subscriptions to the TriNet multi-user platform of internet-based games. TrueTech sells 1,000 subscriptions for $60 each on January 1st of 2018, and the subscriptions start immediately. TrueTech has a single performance obligation to provide a service to subscribers by allowing them to access the gaming platform for 1 year. Note that TriTech users consume the benefits of access to the service over a period of a year. So this contract qualifies for revenue recognition over time under the first criterion stated earlier. So on January 1st, TrueTech recognizes a deferred revenue liability for $60,000 associated when receiving cash prior to satisfying its performance obligation. TriNet subscribers receive benefits each day they have access to the TriNet network, so TrueTech uses proportion of time as its measurement of progress towards completion. At the end of each of the 12 months, TrueTech recognizes subscription revenue of $5,000. After 12 months, TrueTech will have recognized the entire $60,000 of TriNet subscription revenue, and the deferred revenue liability will be reduced to 0. If a performance obligation doesn't meet any of the 3 criteria for recognizing revenue over time, we recognize revenue at the point in time when the performance obligation has been completely satisfied, which usually occurs at the end of the contract. Many services are so short-term in nature that companies don't bother with recognizing revenue over time, even if they qualify for doing so. For example, UPS picks up a package and delivers it to its destination within a few days. The company's Summary of Significant Accounting Policies disclosure note indicates that revenue is recognized upon delivery of a package or letter. In other words, UPS recognizes revenue upon completion of service rather than over time during the service period. This departure from GAAP is immaterial given the short duration of UPS's services and the lack of additional use for information that would be provided for more precise timing of revenue recognition. When revenue is recognized over time, companies have to estimate progress towards completion of the performance obligation. This estimate can be done based on input or output methods. An output-based method estimate of progress toward completion measures the proportion of the goods and services transferred to date. Examples would include miles of road built, tons of coal delivered, or days of interest incurred. On the other hand, input-based estimates of progress toward completion measure the proportion of effort expended so far relative to the total effort expected to be expended in order to satisfy the performance obligation. A common input-based method is called the cost-to-cost ratio, which compares the cost incurred to date to the estimated total cost expected to be incurred. Here we go with another question for you. Which of the following is an indicator that revenue for a service should be recognized over time? A, the seller is enhancing an asset that the customer controls as the service is performed. B, the seller is providing continuous effort to the customer. C, the seller can estimate the percentage of work completed. Or D, the sales price is fixed and determinable. The correct answer here would be A, because revenue is recognized over a period of time if one of the following three conditions holds. So, one of the three conditions is the customer controls the asset as it's being created. Let's look at exercise 5.2. Fun Ski Inc. operates a downhill ski area near Lake Tahoe. An all-day adult lift ticket can be purchased for $75. Adult customers also can purchase a season pass that entitles the pass ski holder to ski any day during the season, which runs from December 1st through April 30th. Fun Ski expects its season pass holders to use their passes equally throughout the season. The company's fiscal year ends on December 31st. On November 6, year 1, Jake Lawson purchases a season pass for $750. So when should Fun Ski recognize revenue from the sale of its season pass? Prepare the appropriate journal entry that Fun Ski would record on November 6th and then on December 31st. What will be included in the Fun Ski Year 1 income statement and balance sheet related to the sale of the season pass to Jake Lawson? So, when would we recognize the revenue? Well, revenue is recognized over time if either the customer consumes the benefit of the seller's work as it is performed, or the customer controls the asset as it is created, or the seller is creating an asset that has no alternative use to the seller, and the seller has a legal right to receive payment for progress to date. If those are the three requirements, then Fun Ski is going to recognize revenue over the ski season. Fun Ski fulfills its performance obligation over time as it delivers the service to its pass holders by providing the access to the ski lifts beginning on December 1st and ending on April 30th. So the journal entry initially would be a credit to deferred revenue. It's a liability, and a debit to the cash of $750 to record this cash recognition. Next, on December 31st, since there are 5 months associated with this customer being able to ski, we're going to debit 1/5 of our deferred revenue, or $150, and then we will credit at the end of the first month service revenue to be recognized of $150. What will we show in the income statement and the balance sheet? Well, in the income statement, we'll show $150 of revenue. In the balance sheet, though, we've reduced our deferred revenue as a new balance of $600 as of December 31st. This would be in the current liability section because that sacrifice is going to be consumed within the next 12 months. Many contracts get complicated and may contain more than one performance obligation. In that step, in this particular situation, then steps 2 and 4 of the revenue recognition process come into play. We have to identify all the performance obligations, and we have to allocate the transaction price to each of those performance obligations to determine the amount of revenue that can be recognized when each performance obligation gets satisfied. Goods and services are viewed as separate performance obligations if they are distinct. Now, a good or service is distinct if it is both capable of being distinct, which means the customer could use the good or service on its own or in combination with other goods or services it could obtain elsewhere, and 2, separately identifiable from other goods or services in the contract. The promise to transfer goods and services are distinct in the context of the contract because the seller is promising to provide goods and services individually, as opposed to promising to provide a combined good or service for which the individual goods or services are inputs. So to consider revenue recognition for contracts that contain multiple performance obligations, let's combine our previous 2 illustrations. Assume TrueTech sells a package deal called a TriBox system. Each TriBox system includes a TriBox module and a 1-year subscription to the TriNet. So on January 1st, TrueTech delivers 1,000 TriBox systems at a price of $250 each. And TrueTech receives $250,000 from comp stores on January 25th of 2018. Assume we have decided there's a contract between TrueTech and comp stores. Let's then move on to step 2. The goal is to separate the contract into parts that can be viewed on a standalone basis. That way the financial statements can better reflect the timing of the transfer of separate goods and services and the profit generated on each one. So in our example, both the TriBox module and the TriNet subscription can be used on their own by a customer, so they're capable of being distinct, and they're separately identifiable in that they aren't heavily dependent upon each other. So in conclusion, the module and subscription are distinct, so the contract has 2 performance obligations. First, the delivery of a TriBox module, and then the fulfillment of a 1-year TriNet subscription. Next, we'll determine the transaction price. So the transaction price is the amount the seller expects to be entitled to receive from the customer in exchange for providing goods or services. Determining the transaction price is simple if the customer pays a fixed amount immediately or soon after the sale. That's the case with our TrueTech example. The transaction price is $250,000, equal to $250 per system times 1,000 systems. The 4th step is to allocate the transaction price to each performance obligation based on their relative standalone selling prices. The transaction price of one TriBox system is $250. Because the standalone price of a TriBox module, $240, represents 80% of the sum of the standalone selling prices, 240 divided by the $240 plus the $60, the standalone price of a TriNet subscription comprises 20% of the total, $60 divided by 240 plus 60. We allocate 80% of the transaction price to the TriBox module and 20% of the transaction price to the TriNet subscription. If a standalone selling price can't be directly observed, then the seller should estimate it. Performance obligations can be satisfied either at a point in time or over a period of time, and revenue with respect to a performance obligation is recognized when the performance obligation is satisfied. That timing doesn't depend on whether a performance obligation is the only one in a contract or is one of several performance obligations in a contract. We determine the timing of revenue recognition for each performance obligation individually. The $200,000 of revenue associated with the TriBox modules is recognized when those modules are delivered to comp stores on January 1st. But the $50,000 of revenue associated with the TriNet subscriptions is recognized over the one-year subscription term. As the total amount of $250,000 will be received only on January 25th, it will be recorded as a debit to accounts receivable. TrueTech will recognize subscription revenue for each month during the one-year subscription period. Deferred revenues reduced by $4,167, and service revenue is recognized. After 12 months, TrueTech will have recognized the entire $50,000 of TriNet subscription revenue, and the deferred revenue liability will have been reduced to zero. So to summarize, the core principle of revenue recognition gets implemented by identifying a contract with a customer, which establishes the legal rights and obligations of the seller and customer with respect to one or more performance obligations. Number 2, identifying performance obligations, which are capable of being distinct and separately identifiable in the contract. Determining the amount the seller is entitled to receive from the customer as per the contract. Allocating the transaction price to the separate performance obligations, and then recognizing revenue at a single point in time or over a period of time. So let's take a look at this question. Allen Company wrote a contract that involves two performance obligations. Product A has a standalone selling price of $100, and Product B has a standalone selling price of $200. The price for the combined product is $240. How much of the transaction price would be allocated to the performance obligation for delivering product A? So what we'd need to do here is to look at the $100 divided by 200 plus 100, or 300, times the 240 means we would recognize $80 for performance A, product A. Let's look at an exercise. Media Mars has a big screen TV package consisting of a 60-inch plasma TV, a universal remote, and an on-site installation by staff. The installation includes programming the remote to have the TV interface with other parts of the customer's home entertainment system. concludes that the TV, the remote, and the installation service are separate performance obligations. sells the 60-inch TV separately for $3,400, sells the remote separately for $200, and offers the installation service separately for $400, but the entire package sells for $3,800. How much revenue would be allocated to the TV, the remote, and the installation service? So again, what we'll do here is if the TV's $3,400 divided by the whole package, 85% of the entire package would be for the TV. We do the same with the remote to allocate 5%, and then the installation, of course, would be 10%. Therefore, on the $3,800 package, the TV would be 85% of the full amount, $3,800, or $3,230. The remote, $190, and the installation of $380. Now that we've covered basics, let's now look at some important issues that occur in practice with respect to each of these steps. Contracts can be explicit or implicit based on common business practice. If explicit, they can be oral rather than written. However, there are several criteria that must be satisfied for a contract to exist. Specifically, a contract only exists if it has a commercial substance, has been approved by the seller and customer, specifies the rights of the seller and customer, specifies payment terms, and is probable that the seller will collect the amount it is entitled to receive under the contract. Note that this last criterion is somewhat similar to the contract having commercial substance. A contract does not exist if neither the seller nor the customer has performed any obligations under the contract, and both the seller and customer can terminate the contract without penalty. In other words, either the seller or the customer must have done something that is commercial substance for the seller to start accounting for revenue. The arrangement qualifies as a contract on January 1st, 2018, because that's the date TruTech makes delivery to comp stores. Prior to delivery, neither TruTech nor comp stores had performed any obligation under the contract, and both parties would cancel the order without penalty, so the arrangement didn't qualify as a contract for purposes of revenue recognition. Sometimes it can be challenging to determine whether various aspects of a contract constitute performance obligations. For example, the following are not viewed as separate performance obligations. Prepayments, these are upfront fees paid in advance by the customer for future products or services. Prepayments are included in the transaction price and are allocated to the various performance obligations. They're accounted for as deferred revenue initially, and then they are later recognized as revenue as each performance obligation gets satisfied. Quality assurance warranties, these are guarantees that the product or service is free of defects and are a cost of satisfying the performance obligation to deliver goods and services. The seller recognizes this cost in the period of sale as a warranty expense and related contingent liability. Now, right of return, these are part of the performance obligation to deliver goods and services that the customer wants to keep. They're viewed as a type of variable consideration, and the transaction price is adjusted to account for them. Sometimes it can be challenging to determine whether various aspects of a contract constitute performance obligations. The following are viewed as separate performance obligations. An extended warranty, or there's an additional service that covers new problems arising after the customer takes control of the product. We view an extended warranty as existing if the customer has the option to purchase it separately, or if the warranty provides a service to the customer beyond quality assurance. The longer the warranty, the more likely it qualifies as an extended warranty. Extended warranties are recorded as a deferred revenue liability and then recognized as revenue over the extended warranty period. An option granted to the customer to receive additional goods or services at no cost or at a discount also qualifies as a performance obligation. This can be software upgrades, customer loyalty programs, discounts on future goods or services, and contract renewal options. Options for additional goods or services are considered performance obligations if they provide a material right to the customer that the customer wouldn't have received otherwise. So when a contract includes an option that provides a material right, the seller must allocate part of the contract's transaction price to the option. Just like for other performance obligations, that allocation process requires the seller to estimate the standalone selling price of the option, taking into account the likelihood the customer is going to actually exercise that option. The seller recognizes revenue associated with the option when the option expires or is exercised. The coupon provides a material right to the customer because it provides a discount of $150 times 40%, which is $60. So it is a performance obligation. TrueTech must allocate the $240 transaction price to two performance obligations, the try box and the coupon. Because TrueTech expects only 80% of the coupons to be used, it estimates the standalone selling price of a coupon to be $48, which is the $60 times 80%. The sum of the standalone selling prices of the performance obligations is $288, equal to the try-box module of $240 plus the coupon of $48. Now the try-box module, $240, represents 5/6 or 83% of the total, the 240 divided by the 288. And the coupon comprises 1/6 or 16.67 of the total. So TrueTech allocates 5/6 of the $240 transaction to the try-box module and 1/6 to the coupon. Let's take a look here at a question. Scale Company offers a promotional coupon with every product it sells. The coupon gives the Scale Company customer an opportunity to buy an electric drill that normally sells for $50 for only $30, a 40% discount. The coupon must be redeemed within 1 year of the purchase. Scale Company estimates that 80% of customers are going to take advantage of the coupon. What is the standalone selling price of the coupon? The correct answer here is D. Scale Company expects only 80% of the coupons to be used. It estimates the standalone selling price of a coupon to be $20, then times 40% of 50 times 80%, or $16. Here's another one. Hooper Inc. offers a discount on an extended warranty on its iPhone. When the warranty is purchased at the time the iPhone is purchased, the warranty normally has a price of $300, but Hooper offers it for $240 when it's purchased along with the iPhone. Hooper anticipates a 75% chance that a customer will purchase the extended warranty along with the iPhone. Assume Hooper sells 1,000 iPhones with the extended warranty discount offer. What is the total standalone selling price that Hooper would use for the extended warranty discount option for purposes of allocating revenue among the performance obligation of those 1,000 iPhone contracts? Well, as you see here, the $60 discount has a 75% chance of being taken by a customer. So the standalone selling price of options provided with 1,000 iPhones is $45,000. It gets calculated as $60 times 75% times 1,000 phones. Let's look now at exercise 5-5. On March 1st, year 1, Aqua Gold receives $294,000 from a local bank and promises to deliver 100 units of certified 1-ounce gold bars on a future date. The contract states that ownership passes to the bank when Aqua Gold delivers the products to Trinity's, a third-party carrier. In addition, Aqua Gold has agreed to provide a replacement shipment at no additional cost if the product is lost in transit. The standalone price of a gold bar is $2,880 per unit, and Aqua Gold estimates the standalone price of the replacement insurance service to be $120 per unit. Trinity's picked up the gold bars from Aqua Gold on March 30th, and delivery to the bank occurred on April 1st. First of all, how many performance obligations are in this contract? Then we're going to prepare the various journal entries. So we've got two obligations in this contract: the delivery of the gold and the additional insurance. The journal entry to record on March 1st is we first have to determine the breakdown of both contracts. So the gold bar normally sells for $2,880. Now we've got the two contracts, the standalone gold bar plus the insurance of $120. So the price of the gold bar to the whole piece is 96%. The insurance is 4%. Therefore, the gold bar would be valued at $282,240 and the insurance at $11,760. So our first journal entry would show the debit to cash. The credit is for the deferred revenues of the gold bars. And then we would also show the deferred revenues for the insurance. Remember, the bank did not get delivery until April 1st, therefore it is deferred revenue. Then on March 30th, when they picked up the gold bars, the revenue would be recorded on March 30th because that is when revenue is going to get recognized in this instance. The deferred revenue, gold bars, would be debited because the revenue has in fact occurred. Now, as far as the insurance goes, that piece would be recognized on April 1st once they were delivered to the bank. That insurance has now passed.